Hello, everyone. It's PJ Patterson here from Market Update. Today is Friday, the 8th of April. Hope you're all looking forward to a good weekend and then a short week next week with Easter break looming. I am back from COVID. Thank you all for the wishes that some of you left on the boardroom. Really appreciate that. It was not much fun last week, being exhausted, very tired, having a horrendous sore throat, and just feeling like a warmed up piece of poo. But anyway, it was nice to get the messages and back in the office now. Not 100%, but pretty darn close. So still having a little bit of fatigue in that. I think I'll just continue to take it easy and rest up. But at least we've got Easter break coming up and a short week next week and the weekend to look forward to as well. Today I'm going to go through a whole bunch of information around, again, the three key things that go into the global macro, the full cycle investing process, the global macro view, how we develop that, what it means, and what we have to look forward to. I've done this before, but I just had a quarterly macro update from Hedgeye, and there's some tables and charts and graphs and things I'm going to go through with you. It is a little bit, in the weeds for those of you who don't like to get right down into the detail, but it will give you some great insight into exactly what I think and what Hedgeye thinks is going to happen going forward and where we are right now. This is key because, of course, the bond market, and I'll show you this and explain it to you. While the bond market right now has already adjusted interest rates, the Fed is making a big policy mistake in raising interest rates, which is going to make quad 4 even worse now that we're in the second quarter of this year, where we have comps and other things that are just going to be impossible to lap. And again, I'll show you some charts on this. We're going to enter a period where we're going to see a reversal in what's been going on in the bond market. Now, for those of you, and I know there's a few of you that watch your accounts all the time, the bond trade hasn't been working yet, but it's going to start working here very soon because the Fed is about to, they've already started to make policy mistakes, but they're about to make another one coming up very soon, and that's if they put interest rates up again at their next Fed policy meeting. The stock market has already reacted negatively to this, and it's going to get worse. So let's get into it. So really, the top three things today are those three things that are the global macro factor model: growth, inflation, and interest rates. And I'm going to actually start with growth today, which is why I've got this chart up on the screen right now. What this is showing us is that GDP is slowing in the U.S. It was already going to slow. We had a GDP number back in the second quarter of last year, which was just a phenomenal, once-in-a-generation GDP number because of all the stimulus and the fact that we had 3 quarters of negative GDP and massively slowing GDP the prior year in 2020 with COVID. And so this is why right here, this speed up in GDP and then this massive number here in the second quarter, then third quarter, and then the fourth quarter, pretty strong GDP numbers, why we had like 6 quarters of consecutive quad 2s. But now we are in a slowdown mode with GDP, and as you can see here, there's a few GDP numbers on here, but the blue line is probably the one to really take note of. We've gone from 5.5, we're going to slow to 4, almost 4, a little over 4, then slow to 3, tick up slightly to 3.5, then slow down again. This is all during the course of 2022. So we are already entering a slowdown period, and this could be worse. These numbers could be worse by the time we actually get there. One of the reasons for that is because of inflation and the fact that we have had oil prices and other commodity prices that have been high for a couple of quarters, and that will have effectively destroyed demand. So there will be demand destruction because of elevated oil prices, elevated commodity prices like lumber and iron ore and materials like concrete and so forth. So these GDP numbers that are estimates right now could actually be worse. But the point is that GDP is already slowing, and you do not want to be raising interest rates into a slowdown. That is a recipe for quad 4. And it's something that I've been saying over the course of the last couple of updates, but it's now really, you're now really going to start to see that because we have, let me just get to the next slide I wanted to show you. Because we have, and I'll just pivot to inflation quickly because it's one slide that I'm going to show you on inflation. I'm going to get in more into growth and then start talking about interest rates. But it's because we've had this elevated amount of inflation. So we've gone from, pretty benign, almost zero inflation, ramped right up. And this again is why we had 6 consecutive quarters of quad 2 because we were reinflating. And now we're not deflating. There's a difference, and I actually didn't know really the difference or understand the difference between deflation and disinflation. We're actually entering a disinflationary period. What's the difference? You're probably wondering. Well, the difference is that, as you can see here, we still have pretty elevated levels of inflation. So we're going from, say, 7, almost 8% inflation in this first quarter of 2022 down by the fourth quarter to, say, 5.5% inflation. So inflation is still pretty high, like 5.5% inflation. On a CPI inflation rate is pretty darn high, but it's decelerating. So the rate of change is actually falling, which is disinflationary. So things will get cheaper. I presume that the supply chain will open up more, and we'll have a return to hopefully some normalcy with oil prices. Those have already begun to come down. I think that oil prices are going to begin to fall a bit quicker now. But in any case, we're not entering a deflationary period, which is really bad. The policymakers don't want deflation, and it's actually pretty rare to have an outright deflationary environment. But what you can, again, have is disinflation, which is really to say that inflation is falling. Things are, I don't want to say deflating, they're disinflating. It's quite bizarre, the semantics of it all. But if you were to look up a definition of the two things, you would see they'd be very different. So we're in a disinflationary period right now, and that's what this chart is really showing us. So what does that mean in the context of other things like growth, etc.? So let me just go to the next table that I wanted to show you. And I just want to talk a little bit more now about our growth rate. So I love these cartoons. I don't show them very often, but here's Jerome Powell getting ready to hike interest rates in quad 4. The quad 4 linebacker's just going to pummel this poor guy. That's pretty much what's going to be happening in quad 4. But the numbers behind it are, it's just mathematics, right? And let me just blow this up so you can see this number. We were going to enter a slowdown period anyway because of we had a fiscal cliff that was coming. So this is the amount, I believe this is the amount of money that the U.S. government is basically spending. So they've gone from something like 6.8 trillion of spending to 5.5 trillion of spending. That is a 1.3 trillion dollar difference in just government spending alone. And so, excuse me, I'm still coughing a bit, especially when I'm talking a lot. So that in and of itself is going to suck a lot of money that has been printed and put into the economy out of the economy. So that right in and of itself makes a huge difference. It's going to be a massive drag on GDP just because of that, just because of the fiscal spending slowdown. We're going to see a slowdown in growth. Now, what this also, well, not what this also, but what one other thing that also is happening is these stimulus that occurred last year in January and then in March of last year, where the government, in the U.S. anyway, and we had some similar stimulus happening in Australia, where the government was basically, printing money and giving people checks, so they were sending money to people, and that is gone. All of that fiscal stimulus is now gone. So if you just sort of look at the right-hand side of this chart, you see the green bar, which is massive here for, in a couple of periods of over the last 2 years or so, is now pretty tiny. And again, that's going to make a big difference to GDP. Furthermore, I've already shown that chart, sorry. Furthermore, we've got, I'll just make this a little bit smaller, we have comps that are not going to be comparable. So what does that mean? I've said that before, so let me just explain what that means. when you look at a data series, you look back at the same period for the previous year. So in other words, we're looking at the June quarter of 21 here. That's what all these red bars basically are, is the June quarter of 2021, where we had the effect of all of the government spending plus the reopening of the economy plus the demand that was built up because everything was shut down, and we had that one quarter where just everything opened up. People got stimulus checks, the economy reopened, and people just went nuts. And so things like retail sales had a huge quarter, like 33% growth in a quarter is just, again, once in a generation. That will not ever be comped. Ever is a long time. It's unlikely that that will ever be comped. And certainly the June quarter of this year, we've seen already, a slowdown in retail spending. So basically what's happening here and across several areas of the economy, so core capital goods, durable goods, retail sales, you have uncomparable comps. So we're going to see corporate earnings in particular and business spending, things of that nature, are already going to slow. So it just supports the whole idea that we have a huge slowdown in growth that is occurring. And this is a problem for the economy as a whole. And this is just an example of where we're seeing deceleration in some things. I'll just show you a couple of slides. So this is the International Supply Manager Service Index. It has just fallen off a cliff. We had all-time highs back probably a couple of months ago, and now we're heading back down below the line, which is towards the line, which is recessionary. We're not there yet, of course, but we're headed that way and falling fairly precipitously. You can say that about a couple of other index measures. I'll just go to, what is that, slide 31, slide 32. This is manufacturing sentiment. It's on its way down. Sorry, let me go to slide 33. I think business confidence. Again, this is waning. So we've seen the all-time high back in sort of 18, 19, just prior to COVID, and business confidence. Yes, we've had some spikes and things like that because of various stimulus checks and stuff, but that's slowed down quite substantially. And a big metric in the U.S. is pending home sales. We've seen a massive decline in pending home sales, and that is also a function of the fact that interest rates are rising. So let me pivot now. So just to lock off the whole growth story, the key thing that you have to understand about the largest economy in the world, which is the United States right now, it is slowing. Rates have already risen. I'm going to talk about rates now, but we're entering that period of time where we're going to see, I think, a bit more of a correction in the stock market because of the fact that growth is slowing, and it's slowing massively, and that's across the board what we're seeing in the metrics. Now, let's talk rates. So the bond market, and I've been saying this now for a little while, but the bond market knows something is up. And by that I mean we went through a period of time where rates were rising for probably a good, I'd say probably they were rising for probably 6 to 9 months over the course of last year. And now rates have gotten to a point where the rate hikes that the Fed is purportedly going to be, making to the cash rate, they've already kind of been priced in. I'm going to show you a table on that in a moment. But one of the key measures to look at is this spread between the 10-year rate and the 2-year rate. And when the spread narrows or inverts, so this is when the 2-year rate is higher than the 10-year rate, it's a bad sign. And this 10-2 spread, which is this blue line, as you can see, has been falling. And the black line, which is the 1-year forward, the 1-year forward 10-year 2 spread. The bond market's been anticipating it falling, which usually leads the actual 10-2 spread, which is also falling. And it may actually enter, and we've had a couple of days in the last, I'd say, week and a half or so, 2 weeks, where rates have actually gone negative in certain short-term interest rate. Certain of the short-term interest rates, they've actually gone negative, and this is not a good sign of future economic activity in the U.S. In fact, it's a very bad sign. And so what that means is this chart is showing us where we've had, if you look again at the black line, which is the 10-2 spread, 1 year forward spread, when it declines as precipitously as it has, you often then see a correction in the S&P 500, which is the blue line. And now we haven't really started to see, and this chart's a couple of days old now, but we've started to see the S&P 500 beginning to correct. We've seen bigger corrections already have happened actually in the NASDAQ, in the Russell. I think the NASDAQ's down about 15-16% this year. The Russell's down something similar to that. The NASDAQ, the S&P is only down about 5 to 7% at the moment. But if history is any guide to what could happen to the S&P 500, the last 3 times we sort of, and that's what these red circles are all about, the last 3 times we saw the 10-2 spread really dip below, we saw, and there was a lag, but we saw that over the next period, a period of time, it could be anywhere between 4 to 24 months, as you can see here from this chart, we saw a pretty substantial decline in the S&P 500. So I'm just pointing this out because this is one of the reasons why I'm broadly not owning any equity exposure, at least growth exposure and some of the other factors that you want to own when, say, we're in a quad 2. We don't own those things in quad 4. So again, just pointing out this is a bad thing. This black line here has dipped, has fallen precipitously, and I would expect to see the S&P 500 follow suit. Now let me flip to chart page 49. So what is actually happening with rates and the pricing in of rate hikes? So what we've seen the market doing is pricing in somewhere between, and it's been oscillating, but somewhere between 7 to 9 rate hikes. And so the market is saying we have adjusted rates because we expect the Fed to raise somewhere to get the cash rate up to around 2 to 2.5%, something in that range. That's what this market expectation of rate hikes is all about. And right now, or as of this chart, it was 8.27 rate hikes. But let me go to this chart. What's happened? This is a very busy chart, but what's already sort of happened is the Fed has already raised rates, and this probably will sound, it'll be a little bit confusing, but I'll try to explain it. So as I've often said, the bond market is actually where rates get set. The Fed just has a cash rate or their Fed funds rate, and they set that rate. But the way they actually influence interest rates is they use this thing called open market operations, and they're in the treasury markets and the treasury bill markets, and they're buying and selling bonds in order to, or buying bonds, which is the quantitative easing. When you've heard that term quantitative easing, or QE, that's what the Fed is doing. They're actually absorbing or buying all of the rates, all of the bonds out there to effectively bid the price up to lower interest rates. So the Fed is one of the biggest buyers of, or excuse me, the Treasury is one of the biggest buyers of the Fed is one of the biggest buyers of the Treasury's issuance of interest rate securities. And so probably, I don't know, a good 6 months or so ago, the Fed began to reduce the amount of bonds and bills that are government securities, let's just say, that they were buying. So the net effect of that is if they're not in the market buying this stuff left, right, and center, then the market has to absorb them. And the market said for us to continue to be buyers of this stuff, that rates will have to rise. So what this table, which is very busy, is actually saying is that there's actually a shadow rate, and this rate has to do with the fact that, again, the open market operations the Fed uses to influence interest rates, by the fact that they have done, really you could call it quantitative tightening, because they've stopped buying stuff and they've reduced the amount of, they haven't stopped buying, excuse me, I misspoke. They have reduced the amount of interest rate securities they're buying. That is in effect quantitative tightening. So they've actually already raised rates the equivalent of something like I don't know, 5, 6, 7 times, and with a view that if they continue doing what they're doing, then they're effectively going to be having raised rates something like 19 times. So that in and of itself is going to be a problem for the market to absorb all of this government issuance of paper. It's going to continue to drive interest rates up. So what does that actually mean? Well, it means that the Fed is eventually going to have to step back in and do QE because of the fact that the stock market is not going to like rates going up. It's already signaled that it doesn't. At least the NASDAQ and the Russell and other parts of the market complex have kind of said, nah, we don't like it. The bond market gets that, at this stage anyway, it's repriced, that the Fed was going to be doing this stuff, and it has already put additional rate hikes into the market. So interest rates, as an example, have gone from early in this year. I think I've often quoted this metric. The 30-year interest rate was 1.89% on the 27th of December of 2021, and as of yesterday's close, it was at 2.63%. That's the 30-year rate. So it's already gone up, quite substantially, and 80, 90 basis points. And the 2-year rate was at 71 basis points and is now at 2.5%. So the 2-year rate, 2.5, versus the 30-year rate, which is 2.63. You're only getting 13 basis points more for 30-year paper than you are for 2-year paper. That's a problem, and that typically is a sign that we have a very potential recession headed our way. The final thing I just want to touch on as well, and I should have highlighted this under growth, is that we have, and I did say this, we have corporate earnings are going to have a very hard time lapping or comping their growth that they had back in the second quarter of 2022. So this is a chart that shows that massive corporate earnings growth rate with an immediate deceleration. So it immediately peaked at that growth rate of 87.3%, and it's already dropped off, a huge rate of change drop in the third quarter of we'll have a huge drop off in the third quarter and fourth quarter of this year. So we had a ramp off of terrible earnings. So back in the second quarter of 21, just horrendous recessionary type earnings. Then we had this resurgence through 2021 and into this year. Some great corporate earnings reports, and then all of a sudden it's just going to fall off a cliff. And that's going to be a problem. Now I'm at about 20 minutes, so I'm going to wrap this up. But one quick final thing I just want to hit on, and thanks for bearing with that bit of analysis, because just to wrap it all up for you, what it means is that we've got the three key policy factors: growth, inflation, and interest rates. Growth slowing. Interest rates have risen, but they've risen to a level that now is going to really start to have a truly negative flow-on effect to growth. And inflation was a big drag, or has been a big drag, on the economy. We're now disinflating, which is going to mean the Fed will also have cover to change their tune around inflation. So one of the other things you may, if you're watching a lot of financial media, may have been hearing and noticing is the Fed now is all of a sudden really concerned about inflation. They should have been concerned about inflation 6 months ago when inflation was ripping, but they of course claimed it was transitory, and now they're claiming that it's just ripping and it's going to be here to stay and all this kind of stuff, and they're worried about the oil price, but oil's already begun to correct, and for us to have truly have this inflation persist as it has, we'd have to see an oil price something in the $140 a barrel range for a sustained period of time, and we're nowhere near that. I think oil right now, WTI is something like 98, 97, $100 a barrel, somewhere in that vicinity. So just quickly to touch on a couple of other things that I often highlight very quickly is volatility. Now we are in the volatility bucket, which is known as the chop bucket. So the chop bucket is 20 to 30 VIX. We've been as high as sort of 40 VIX, or very close to it, over the past couple of weeks. We've seen a nice pullback in the VIX, but now all of a sudden VIX has begun to elevate again. So as these issues continue to work themselves through. So issues such as the slowing growth, the rising interest rates, the elevated but falling inflation, we should start to see we should see another spike or pickup in volatility. That's just on the VIX. That's the S&P's volatility. The NASDAQ, which is the VIX-N, and the Russell, which is the RVX vol, are still well into the chop bucket, and frankly, they are bordering on being in the non-investable bucket, but they're quite elevated, and which is probably one of those reasons why the NASDAQ and the Russell have both suffered in terms of performance this year. So these are some things I'm definitely keeping an eye on, looking to take advantage of getting some of the things that we want to own. For example, gold miners is a place that we want to be at this stage, and gold, and waiting for opportunities when vol spikes to buy some of that stuff, because as an example, gold miners are equities, and yes, they will have good performance as the gold price will undoubtedly start to really ramp up as we see interest rates coming down and QE kicking off again, etc. That will be a boon for the gold miners, but they have that added complexity of the fact that they are an equity and they do respond to elevated levels of volatility. So that's just something I got to be careful with and manage. But that's probably, I guess, about it in terms of what I wanted to highlight today. And so again, thank you for bearing with this slightly longer update because of the density of the data that we have to go through. But the final thing that I would like to just say to you is Quad 4, the last time we went through a meaningful Quad 4, which was back in 2019, early 2020, it took a couple of months for the Quad 4 to really develop. And typically what will happen is once we make a pivot to a quad, it doesn't just happen immediately that we're going to get performance. There's often a period of time where we do get volatility and we get the market sort of catching up to the macroeconomic view that we have going forward. I don't expect that this time will be different broadly. There could be some nuances in the way this Quad 4 unfolds, but it's very likely to deepen as we get deeper into the second quarter. What does that mean for the portfolios? Well, it means that we want to be owning, again, defensive assets, things like gold miners, the bond market ETFs, and a couple of other things like silver I've added, and the gold miners as well. So, and we'll be staying away from broad exposures like tech, consumer discretionary, retail, all the things basically that work really well in Quad 2, you don't want to own in Quad 4. And with that, I will say have a wonderful weekend. We do have a short week next week, so if nothing major happens in the markets, I may not do a market update, but you guys know me. I'll probably be in here on Good Friday, and we'll do a market update for you. But right now, just sit tight, be patient, and wait for and watch this Quad 4 to unfold. And and cash. That's one of the other things I've done is just raised a lot. Usually now in a Quad 4 environment, I'm raising a little bit larger amounts of cash than I probably otherwise would hold. But anyway, enjoy your break, enjoy your weekend, and I'll come back with more next week if we need to. Have a good one. Talk soon. Bye-bye.